I'm Lee Scully. I'm an associate investment advisor with Bishop Cross Border Investment Services. And today I sat down with Riaan Botha. Riaan is an associate vice president, estate and trust solutions with Solus Trust, an affiliate company of Raymond James. Riaan and I discussed estate planning, the do's and don'ts, the things to watch out for, and especially cross-border estate planning concerns. Riaan has over 20 years experience in estate and trusts and has practiced as a lawyer specializing in commercial and civil litigation, insurance law, and trust and estate law. He holds a Bachelor of Commerce degree and a Bachelor of Laws degree from the University of Pretoria in South Africa, as well as a postgraduate diploma in taxation from Thomas Jefferson Law School in San Diego. Riaan also earned a business administration degree from the Gordon Institute of Business Science in South Africa and is a member of the Society of Trust and Estate Practitioners. Riaan and I had a very interesting conversation. I think you'll find a lot of value in it, and I hope you enjoy. All right. Riaan, thanks for joining. Really appreciate it. We are May 28th, 2026. Looking forward to having a good conversation about estate planning, which is not super riveting for most, but I think it's a very important topic. So happy to have you on.
Perfect. Thanks for having me.
Let's just jump right into it. Maybe a high-level question for you to kick it off. For someone who hasn't thought much about estate planning or doesn't really understand what that entails, what is estate planning? Why is it a good idea to have an estate plan?
Yeah, so estate planning really comes down to control and clarity. It's about making sure that if something happens to you, your wishes are followed, who gets what, and who's being put into the position to make decisions pertaining to your assets, your family, etc. So the reality is everyone needs an estate plan. If we look at the Canadian landscape, it is an aging landscape, and unfortunately, we still have in excess of 50% of Canadians that do not have a will. If we go down to the younger generation, that increases to about 70% that do not have a will. So, as part of my job, it is educating people and making sure that they've got something in place, and then educating even further to say that you need to regularly then update that plan so it stays up to date. So, without a plan, you don't have anybody to make decisions on your behalf. And it goes down to provincial laws then to determine how the estate should be administered.
Right. So what would be the consequences of not having an estate plan? Let's say it goes into the provincial courts. What typically happens?
Yeah, so then it's going to be a court application process in order to appoint the executor, and there's set rules on how the distribution of the estate will take place. So if you, for instance, wanted to keep assets held in trust for the benefit of beneficiaries until they attain a certain age, you're not going to have the ability to do that. I currently have a case where beneficiary of the estate is a 15-year-old child. Was there is no will, there's a significant sized estate, and it is now going to be held by the guardian for the benefit of that child until he attains the age of 18. And trust me, I've been in this industry long enough where I've seen where a 18-year-old that inherits a couple of $1 million, it can quickly disappear if it's not managed properly.
Unfortunately, yeah, that's probably happened more than once. And
Yeah.
it's unfortunate because I think people probably avoid this. And you mentioned the stats around how many people don't have a will or an estate plan, because if you think about it, it's not a pleasant thing to think about. You're thinking of your own demise, but at the end of the day, it comes for us all. So why not plan for the inevitable, right?
Death and taxes.
Death and
So
taxes.
it's
Yeah.
one of those things. So it is, as I said, if you don't have something in place, it potentially causes a lot more damage to the family. Having something basic in place can address a lot of those issues.
Exactly. And I wanted to follow up on that scenario you mentioned, but first I want to stick to the basics for a bit longer. So
Mhm.
what might be the most basic components of an estate plan? So there's the will, maybe there's some power of attorney documents. Can you speak to the key elements?
Yeah. So remember, estate planning, a lot of people think it is purely looking at the will. it is not just looking at the will. It is looking at powers of attorney, both financial and healthcare. So should you become mentally incapable of managing your affairs, who's going to then step in and make those decisions on your behalf? And trust me, that happens more and more often nowadays. People do live a lot longer, and unfortunately, we get into more situations where cognitive decline becomes an issue, and we need to then effectively address that. Then we also need to look at beneficiary designations. So making sure beneficiary designations on registered plans, insurance, etc., is up to date in order to maximize tax efficiency from a probate planning as well as transfer of inheritance perspective. And then looking at minor children, who's going to be the guardian? Who's going to be the best parent for the kids? And what people often think is the person that gets appointed as the guardian also needs to be the trustee. That's not the case. I'm a firm believer that guardian is going to be the person that's going to be able to be the best parent in that case. Trustee is the person that's going to be able to manage the assets best for the benefit of the minor beneficiaries.
Right. Couple key things to unpack there. One thing I get asked a lot is, do we name beneficiaries on our accounts or do we name them in the will? And often that will differ depending on what type of account we're looking at. Would you like to speak to that for a moment?
Yeah, yeah. So again, it depends on the overall construct of the estate and how it should be distributed. So remember, when you die in the Canadian landscape, there's taxes. In order to effectively manage those taxes, you need to have a proper estate plan. So, for instance, if you have a significant amount remaining in a RSP, the full amount of the RSP is taxable. If you put on your adult kids as designated beneficiaries on the RSP, they'll get the full value of what's remaining in the RSP, but the estate is then still responsible for the taxes. And if there isn't sufficient liquidity available in the estate itself, then the executor is going to come knocking at the door to say, I want some of that money back in order to cover the expenses. So, and that's why it's important that estate planning is never looked at just from a legal perspective, but you look at the overall picture.
That's right. I want to continue on the beneficiary topic for a moment, but first, I think I want to branch out to a little side note here because you touched on liquidity. So often, upon death, there are deemed dispositions and things that trigger upon someone's death. What role could insurance sometimes play in an estate planning exercise?
Yeah, I'm a firm believer that insurance should be part of almost every single estate plan. It creates liquidity at death to cover taxes. It can assist in protecting dependents. Depending on the value of the estate, it can also create opportunities from a tax planning perspective to minimize the implications at date of death. So we often nowadays find where people with significant wealth might take assets from an investment hand and move it across to an insurance policy that then pays out tax free to the beneficiaries to then start building up wealth again within the next generation without having to incur the tax benefit. So there are definite benefits to insurance. And for me, again, is the basics of covering death taxes, so capital gains implications, and then death expenses. And then secondly, to cover the additional liquidity. And then from a planning perspective, there are opportunities to minimize taxes then as well.
Right. And in some cases, it can be an incredibly tax efficient strategy if used properly. And I think it can be overlooked sometimes, but that's an important part of the whole puzzle.
Agree, agree. We attended a conference last week on more insurance planning opportunities, and I could definitely say it opened up some of the advisors' eyes to see the opportunities available for them to educate their clients and potentially better position insurance as part of their value offering to clients.
Right. Yeah, we're beginning to do more and more ourselves just as as our clients start asking these questions and we deal with different situations, right?
Yeah.
So certainly important.
Yeah.
On the same vein as the beneficiary conversation, I want to backpedal a bit to that scenario you mentioned where the children are minors, so
Hmm.
below the legal age, uh, which would allow them to actually inherit and hold an investment account, or maybe it's not an investment account, maybe it's a different kind of asset. What happens? What kind of planning can be done around that? Because it could be very problematic if they are named beneficiaries and something horrible does happen to the account owners. What kind of planning can people do there?
Yeah. So if you're proactive and look at your estate plan before death, then looking at options such as setting up a testamentary trust in terms of your will is a good option to consider. So you can, for instance, specify in your will that assets should go into trust for the benefit of my children until they attain a certain age or the happening of a certain event. What a lot of people nowadays do as well is they stagger the capital distributions over time. I've been in this industry now for 25 years. I've seen it where an 18-year-old inherits $2 million and within a year, it's all gone, nothing to show for it because that child did not know that there was significant wealth in the family and wasn't brought up in such a way to best manage those assets. I normally say that putting a trust in place is not necessarily dictating from the grave, but it's providing guidance from the grave on how to better handle an inheritance. It is also a situation of it is the fire hydrant approach versus the faucet approach. So fire hydrant approach is there you go, there's your inheritance, do with it as you like. Faucet, you open the tap slowly and give it over a period of time to better enable the beneficiaries to then utilize their inheritance better. And you can also specify that certain income should be paid out to them for day-to-day necessities, and then also give the trustee the discretion to make additional distributions out of the trust should they, for instance, have the need to purchase a property, start a business, etc. So it's not going to completely dictate on how assets should be distributed, but you've got the ability then to provide a bit more guidance as a result of that.
Right. And how would someone go about choosing a trustee? So, what kind of conversations would they have to have with that person to make sure everyone's aligned? And I'll just give you one example that we came across recently that was quite interesting. A young couple, had a trust, and the trustee, who happened to be the same person as the guardian in the event of the couple's untimely demise, was actually a resident of Europe, in a European country, which can add some complexity to the whole picture. What kinds of conversations should someone have, and what kind of things should they consider when they're appointing a trustee and a guardian, for that matter?
Yep. Yeah. So if we look at trustee, there's six things that I normally discuss with clients. First one is time, because this is a timely job that somebody gets appointed and never applied for the job. So if you've got a full-time 9 to 5 job and you need to now settle mom or dad's estate after their passing, it takes up a lot of time. On average, an estate takes between 570 hours of effort over a period of 16 to 18 months. So it's not always complex, but it's time consuming. Second one is age. So if the person is of a same or older age than you need to ask the question, what's going to happen if that person passes away before you or becomes incapacitated and is acting as trustee of an ongoing trust? Who's going to then step in and take over? Third one is knowledge. This is an ever-changing industry. I would say the last 10 to 15 years globally, there's been big changes pertaining to estate and trust administration, as well as taxes pertaining to that. So if the person that is acting in that capacity does not have the knowledge or ability, then is that actually the right person for you? Fourth one is executor location. To your earlier example, if, for instance, an executor is a U.S. resident, then you bring in a whole new complexity from potential tax implications. Because remember, the day you pass on, your estate in essence becomes a trust. And if you've got a US resident executor or trustee acting in that capacity, then there might be additional tax implications and other implications. Fifth one is looking at assets outside of jurisdiction. So if you have assets in another province in Canada, or even worse, in the US or in Europe, then we need to determine what's going to be the best way to handle this from an administrative and tax implication perspective to avoid any pitfalls. So if it might be necessary, then we might look at doing a Canadian will, and we'll do a will for the assets in a separate jurisdiction. And then the final one is personal liability. So if the person does not have the ability to effectively do this, then they can be held personally liable for acting in the capacity for any decisions that they do wrong while acting in the capacity as a state trustee.
Right. That's a lot to consider. And I think especially if it's someone who doesn't fully understand what they've signed up for, accepting a role as a trustee, that can often make them feel like they're really in over their head.
Yeah.
What advice might you have for someone setting up a trust or revisiting a trust about a corporate trustee appointment versus appointing a brother or a sister or a relative?
In almost all discussions I have with clients, when I ask them the question, have you acted as executor or trustee before? And if they say yes, and I then follow up to say, will you do it again? Most of them will say no. It's not something I'll do again. It is, as I mentioned earlier, it's one of those jobs where a lot of people take it on without actually applying for it. I've even had situations now where clients have phoned me, sons or daughters have phoned me to say, listen here, I want you to have a discussion with my parents to say, I don't want to act as executor or trustee for them. My response to that is, you go to a professional to get your documents drafted. Go to a estate planning lawyer to get the documents drafted. Now, when you pass on, why do you want to leave that to an amateur to execute? This is what we do on a day-to-day basis. We're a federally regulated trust company, and we act as executor, trustee, and POA. And if you have the ability to then appoint a professional, as I said, you take away that potential liability exposure to friends or family, and you know that everything's going to be done impartially. Because what often also happens is people appoint both, let's say they've got two kids, they appoint both kids as joint executors. But we all know that one is most likely going to do all the work, but the estate's going to be distributed equally between the two of them. That's normally where the infighting then starts to say, but I'm doing all this work, sitting and putting in the hours, but when it comes to the benefit, we're both receiving the same. That's where an independent professional trust company will remove that burden and avoid potential conflict between family.
Right. All great points. I'd like to move on from the trust topic. However, just to put a bow on all of that, I think it's important for people that are interested in the topic to know where to start. How does someone go about setting up a trust? Who do they need to contact? How do they get started?
Yeah, I would say first port of call is have a discussion with your financial advisor to look at what the current construct looks like. And then as part of the bigger Raymond James offering, we then provide that service where we can have an engagement where, as I said, I can, with the advisor, sit then and have a discussion on what does the financial side of things look like? What is your wishes pertaining to estate distribution? And then see how to best optimize the structure from there. We cannot do the actual drafting of the documentation, but the service that I then provide is I'll provide firstly insight, and then secondly a proposal on how to best structure this that it addresses all your needs, whether it be from a guardian, trustee, or executor perspective, what needs to be done, as well as then demystifying potential issues pertaining to cross-border assets, beneficiaries, and all those things. So estate planning in my opinion, is never cast in stone. It should be easily adaptable as and when things change during your life, but have a discussion with your financial advisor to provide that guidance. A good financial advisor is not just a person that looks after your investments. A good financial advisor is somebody that looks after the entire wealth offering. So, as part of Raymond James, we provide the Total Wealth Solutions offering to all our clients, where we have the ability to look at insurance planning, tax consulting, philanthropy, investment management, trust and estates, and all of that to be able to provide all the clients with a full holistic wealth management offer.
Right. And it all fits together. It all works
I agree.
together.
I agree.
That's exactly right. So let's zoom out for a moment. Trusts are part of the discussion around estate planning in general. And I know we've been talking a lot about some cross-border topics. So, trustees in Europe or assets in the US with Canadian residents. One thing we see a lot, and our clientele are normally either American expats that now reside in Canada or sometimes vice versa. In general, what should those people be considering, and what are some questions they should be asking about their estate plans? For example, a lot of people ask, should I have a will in the US and Canada? Do those need to talk to each other and line up completely? A lot of people are a bit scrambled, for lack of a better word, when they find us and they wonder how to get all of their ducks in a row. Any thoughts on that?
Yeah. So again, depending on the asset composition, the complexity within the family, that will dictate what's going to be the best option to consider. So if we look at firstly the cross-border side of things. So first thing is, let's say there was an Ontario estate and the person is a US citizen. So remember, as a US citizen, doesn't matter where in the world you are, there's tax implications in the US. So if your estate exceeds 15 million US, then there might be potential US estate tax implications. If we're sitting with an estate where the US resident the U.S. resident's son or daughter has now been appointed as the executor, as I mentioned earlier, then there's potential tax implications, because what we look at is the actual control and management of the trust, which is determined by where that person is resident, might then open up additional implications from a tax and administrative perspective. If an executor is also outside of Canada, then there might be an implication that an estate administration bond needs to be taken out. So an estate administration bond is basically the court saying, I want a bond to make sure that everything is handled the way it's supposed to be, and that taxes payable will be paid, and that somebody that's acting as executor that's not a Canadian resident is not going to walk away with this, and then there's no recourse for us to then go after that person. And the state administration bond is not a cheap bond to take out, because normally it will have to be double the value of the estate, and there's not a lot of companies that do provide that service. So firstly looking at the executor, where that person is a resident, is important to determine the best way. Then if we look at US resident beneficiaries as part of the estate, again, depending on whether this is outright distributions to them as beneficiaries out of the estate, remember there's no tax implication on them receiving the inheritance. In Canada, the day you pass on, there's a deemed disposition. The estate is then responsible for paying the taxes. The recipients, in most countries, do not pay a tax. There are certain countries that the recipient pays a tax, but if they're US resident, then there's no tax payable on the capital. But let's say, for instance, you stipulate in terms of your will that the cottage goes into a Canadian trust that the Canadian trustee then manages. That cottage is then rented out, and the income received from that cottage, from the rental, is then distributed to the beneficiaries. In that case, there might be withholding tax implications that's going to be in place. So again, depending on client-to-client situations, we will provide guidance on how to best structure this. And as I said, never to be cast in stone, because we don't know what's going to happen asset and beneficiary wise in the future. And should something change, you should be able to easily adapt that over time.
Right. Yeah, everything needs to be case by case. Everything needs to be dynamic because everything's different. There can be many layers of nuance. So I completely agree with you.
Yeah.
Are there any very common mistakes or things that people overlook in these cross-border estate planning situations?
Yes. So again, people try and overcomplicate things as soon as there's cross-border implications. And as I said, then might look at trust planning as part of that. But again, because the Canadian and US tax systems don't line up, then it might create issues. As I said, if you've got a Canadian trust that generates income, gets paid out to a US resident beneficiary, there's withholding tax. So having flexibility in the will and then the trust to potentially relocate the trust to the US is something to consider. If you have any cross-border exposure, whether that be from an asset or beneficiary perspective, my advice is always to seek professional guidance on this to avoid situations where there's additional administrative and tax implications.
Right. Yep. All good points. I think this is a good segue to closing things out. I know we covered a lot. It's already a daunting topic for a lot of people. It can be very technical and dry. Our goal is to educate. I think this has been a very helpful session. I would like to ask a couple more things as we part ways here. So we talked about how do people start in terms of setting up a trust. Let's just zoom out a bit further. Let's say someone, no, they don't have a will, they don't have anything, they're unsure of how to start. Who needs to be part of that team? So do they need a lawyer? Do they need an accountant, a financial advisor, a trust company? How do they start and who do they need to talk to?
Yeah. So as I said, I would start by first looking at what is the wish? What do you want and how do you want your estate to be divided? Then start having discussion with your financial advisor. Then from there evolve into the lawyer that will be assisting in drafting the documentation and providing guidance. And depending on complexity, then potentially get a tax professional in place. I'm a firm believer in having the family discussion. Inheritance, in my opinion, should not be a surprise, as well as who gets appointed in which capacity. If everybody as part of the family knows exactly what's going to happen, then family dynamics will not potentially elevate any conflict and any issues. And then secondly, you then have the opportunity to position everything accordingly to make sure that there's no issues pertaining to the transfer of wealth. If you have any active businesses in place where the rest of the family is potentially involved, then you need to have both your personal succession plan as well as the business succession. Because remember, there's tax implications on both sides as well as administrative implications. So having the right people around the table to provide guidance is what you need to look out for. And I would recommend that start having that discussion with your financial advisor to be the quarterback in making sure that the right people is around the table. If the need then arises for a trust company to be involved, then that discussion can evolve from that.
It all starts with a conversation.
Yep. Yeah. As I said, I've been in this industry globally for 25 years. I've worked on $500,000 estates, and I've worked with 10 billion US dollar estates. The same principle is there. Keep it simple and have a plan in place. If that plan's in place and it's properly assessed and ticks all the boxes of the needs that you want out of that, then there will potentially not be any issues. It is also not normally the biggest states that the biggest issues come out of. It is the smaller estates where a material object is part of the estate or immaterial object is part of the estate with sentimental value becomes the issue. It is normally one of the first things that I ask a family is there a cottage? If they say yes, what's going to happen to the cottage? Because remember, going to the cottage over the summers is memories built with the family. If it is a situation that there isn't proper planning, and let's say there's 3 or 4 kids that's now going to be inheriting the cottage, they need to understand that the cottage costs money to maintain. If you give the cottage to all 4 kids and they cannot agree on how to cover the maintenance on the cottage, that's when the fighting starts. So having a plan in place to address that and create potential liquidity to cover that will avoid family issues. My biggest goal is to educate. Um, there's way too many situations where the transfer of wealth starts the process of splitting up the family. And if you are properly educated on what the situation is and how to best handle that, then you will potentially minimize that implication.
Exactly. And unfortunately, we've seen that all too often when a family, a rift starts because of all these sentimental things and the emotions that arise throughout the process. And that's one more point about a corporate trustee where or executor even where completely objective third party knows what they're doing, has done it many times, and that can often be a way to avoid those family rifts developing. So we've seen that unfortunately a few times.
Agree. And I've seen it as well on the planning side where, let's say, for instance, it's a blended family. So as part of, we discussed earlier, beneficiary designation. So now it's a blended family, a husband and wife now designate each other as successor annuitant or beneficiary on the registered account. But the intention is for whatever's then remaining to go to the 2 separate families. And if there is a disconnect between that, trust me, that's where the fighting starts. And that's where litigation then ends up in a situation costing the estate more and taking longer for the distribution of the estate. I'm currently dealing with probably 4 or 5 cases where litigation has been ongoing for at least 4 to 5 years, and that's holding up the distribution of the estate. It's never the intention for this to be held back for litigation. It's always there to support the family as the inheritance goes to next generation. An interesting thing that I had a discussion with a client the other day on is you even nowadays have clients that as part of their financial plan incorporate the inheritance that they might receive out of an estate. I'm a firm believer that inheritance is a privilege, not a right. It is the cherry on top of the cake that might bring a different dimension to your personal life. But you have a responsibility to enjoy your life, utilize your assets to the best of your ability. And if you spend it, then that's your prerogative. But again, that's where a good financial plan comes in, provides you guidance on how to better manage that as well.
I agree with you fully.
Cool.
Do you have one final piece of parting advice for people watching that might be wondering about how to start or thinking about estate planning issues? Any last advice?
Yeah, have have a basic plan in place. Have a discussion with your financial advisor to look at options. And if you are in between whether deciding whether to go with a professional trustee or executor or not, I can promise you the amounts of fees that will be payable out of the estate is going to be minuscule compared to the potential other implications if it's done incorrectly. This is something that you do not want to put in the hands of family or friends that could then potentially cause issues. If you have that impartiality of a trust company acting in that capacity, it definitely avoids potential issues.
Right. Riaan, this has been great. Really appreciate it. Look forward to diving into some more topics with you in the future. But for now, I think we'll wrap up. I think it's been very helpful, and I'm sure our audience got some value out of it. So thank you very much.
Perfect. Thanks, Lee. Thanks, everyone.